Hello, and thanks for joining the Mint Diversified Funds monthly market update for June of 2026. My name is Alistair Dring. I'm the Assistant Portfolio Manager for the Mint Diversified Funds. I wanted to do something slightly different this month and introduce our macro risk indicator model. It's helpful for forward-looking review of or forward-looking assessment of how global equities are expected to perform on a macro level. We'll talk through the fund's performance over the month of June, and we'll have a look at sort of the sectors that have attributed to that performance. Please take a moment to note disclaimer. Thanks. So the macro tool has been designed as an input into our investment committee discussions around how we tactically tilt the diversified portfolios. This is on the back of an assessment around, well, we have some really good in-house capabilities in the New Zealand and Australasian, or New Zealand and Australia equity sector, and we wanted to enhance our ability to tilt in the global space, particularly in the diversified funds. And we've gone about that by assessing some leading indicators in the market that have some proven statistical power or explanatory power around how markets might perform, going forward. And we've bolted those together in a way that gives us a signal at a very high level that is taken to a committee to have a discussion around. It is not a tool that we trade on, and particularly around what the signal is giving us, but it's to help inform a robust conversation. So what we're looking at is we've got a 3x3x3 model. It is 3 short-term indicators, 3 medium-term, and 3 long-term indicators, and they're all weighted differently. As you would expect, short-term has a lower weight because we don't want that noise that comes from the short-term whipsawing to unnecessarily muddy the explanatory power of the tool. We've got a heavier weight to the long-term because we're long-term investors. We want that to be a driver of how we position the portfolio based on what those signals are giving us. These are all orthogonal in that they're all unique and focus on a very different part of the market where there's a trading action, where there's structural shifts and changes. So we feel like we've captured a fairly broad assessment of what goes into risk on or risk off, and we've weighted those sensibly in order to give us a reading that is useful. From there, we pulled the data historically to work out, well, what would the indicator have given us over some unique time periods historically, and it was encouraging to see on the chart on the right that at the height of the .com euphoria, there was a reading of significant defensiveness, or at least positioning the portfolio that way. But the static reading in itself is probably not as useful as where those readings went thereafter. And as we progressed through that sort of GFC peak to the trough of 09, to the recovery in 09, what the tool was telling us now, this is a sort of function of the coincidental and the leading indicators there, is more around, well, if you look at the time period from the 2000.com sort of euphoria there to the recovery in 09, is that's quite a significant delta, or the difference between those two. And that's probably where the power is, and why we run this quite regularly, is to pull those readings so we can see the direction of change of the individual indicators, as well as what their static reading might be informing. And we've got some comfort in how the readings are pulling and what the rhetoric in the market is around what those readings might be, as they aren't, there's nothing too proprietary in there, but it is a helpful tool for us for tilting the portfolio. And why we've got a slightly warning amber slightly risky, heightened risk in the signal is mostly from the long-term readings, which are the Shiller's Cape, corporate profits as a percent of GDP, and real interest rates on the 10-year. Now, two of those signals are elevated quite significantly, being the Cape ratio and percent corporate profits as a percentage of GDP. That is where most of the concern is coming from, something that we're keeping a close eye on. They have been elevated for quite some time. Do they persist? And I think these are the right conversations to be having is, well, where do we see that going in the future? Do they mean revert? When does that look likely? And we'll keep an eye on those readings to see if those trends start to take shape, because that's where the risk potentially lies for being on the wrong side of the tactical positioning of the portfolio. So given the risk model, that's sort of a whistle-stop tour, we'll move on to the performance of a few sort of geographical areas and sectors and how that attributed to the fund's performance. So New Zealand equities were a standout over the month of June, up by 2.8%. Largely led by a few individual names that performed particularly well on some idiosyncratic news within the individual companies, but as well as a general fall in the short-term rates locally over the month. Now, as I say this, we've had a rate hike since then, so we've seen how that sort of played out. But over the month of June, falling short-term rates meant that the heavy duration or yield-orientated NZX market had some tailwind behind it and performed well. In Australia, relatively positive. I mean, we'll take a positive when it comes compared to global markets. The RBA held rates at 4.35, but there was a large commodity headwind across the Tasman. And luckily, or probably with a bit of forethought, the team in the Australasian Equity Fund do not have a huge weighting towards sort of commodity-linked names, and that fund performed quite well. In property sector, it's in a significant sort of downturn and is incredibly soft, so no real performance attribution from that particular sector. Looking at global markets and largely sort of US-led, again, that's the main exposure we have in the fund. But sort of a sigh of relief in that the Strait of Hormuz opened up through June. There was a peace deal that had sort of been signed, I guess you could say, but there's been obviously some changes since then. But a lot of those hedges that sat in people's portfolios that have been there for the last year, your golds and your silvers, fell significantly. Naturally, oil has come down on the supply that sort of re-entered the market, and the ability for those ships to pass through and get sort of the lifeblood of the economies to the relevant shores that need them. And again, that would have been a factor in sort of any inflation readings. So with the new Fed chair, Mr. Walsh, kept rates unchanged, but also gave very little forward guidance to markets. Probably on the perspective that capital markets need to do what they need to do, and giving them too much information around, or foreshadowing what is going to be coming up from a Fed perspective can sort of get in the way. So a slightly different approach from Chair Walsh, yet to see how that plays out long term. But there is an expectation that there will be a hike in October, given that there was a pause at the last meeting. And there has been a rotation under the surface, which the Global Growth Fund has been sort of somewhat privy to, in that we have slightly defensive names as well as more cyclical consumer defensives in the portfolio, healthcare being one of them, and the broadening of returns across the S&P 500 has been significant over the month. Quite a significant move out of large AI and sort of global mega cap tech names. Oracle, Microsoft, were big drags on performance over the month, but we were offset with some more defensive weightings, which were positive. Quite a few rate hikes across, Europe, Japan, and there's some softer data out of China. And so that sort of paints the picture. Euro stocks was the only index that was up, in the developed market world. Many of the others down around 1 to 1.5%. Moving on to currency, the New Zealand dollar suffered significantly through the month of June. Probably a component of that being the falling of the short-term rates, relative to the US dollar specifically, and that carry premium that one gets, trading between the NZD and the US dollar would have meant that there would have been a significant fall as rates locally versus the US. That gap has widened up, particularly through the month, and it was a weaker across many of the cross pairs that we have. Although one thing to note, New Zealand dollar was weak across many of the pairs. The DXY, the broad basket of US versus sort of cross currencies, was up about 2%. So that gives you an indication of New Zealand dollar weakness, but also USD dollar strength, resulting in a sort of minus 5.2% performance from the New Zealand dollar versus USD. Now, I bring that up because our performance relative to peers would be notable in that, we were down in the month in the growth fund, particularly where we have our largest USD weighting. We're 100% hedged. We feel that Kiwi investors don't need to take on additional risk in the portfolio, and that would have been a positive attribute to performance had we been 50 versus unhedged. Food for thought. It's an interesting conversation to have around where that sort of hedging lies, but particularly for the month of June. That didn't physically, there wasn't a sort of a negative on that performance, but it didn't positively attribute like it may have done for peers. So something just to be aware of when looking at peer relative performance. Looking at the diversified income fund, a 1.1% return for the month, which was good, largely led by the fixed income component. The team at Wedge have taken over the reins of running the fixed income portfolios for the diversified funds and have been doing a great job thus far. They're largely close to benchmark from a duration perspective. They have a few higher yielding sort of hybrid names, more credit orientated names, but they've been reducing some of that exposure just given the fragility in the market at the moment. But those have all contributed quite positively, as well as the short rates coming down, as we discussed earlier, would have been buoyant for fixed income. Australasian equities contributed 60 basis points to the fund performance, and global equities, as mentioned, headwinds with the tech names that we do hold, meant that we were down around 30 bips in the global side of things. There was some positive performance from our healthcare names, the more defensive players, and then some significant negatives from the global tech mega caps. And then looking at the diversified growth fund, sort of quite the disparity there, down 1% across the month, with global equities down 1.8%, on the back of sort of the larger exposure that we've got to some of the tech names, and we've got quite a concentrated portfolio, but we have been pivoting out towards more defensive names through the month of June, must be said. Australasian equities did well to stem some of that tide, as well as the fixed income contribution as well coming from the Wedge team. Names to call out again: CVS from a defensive healthcare name, adding 31 basis points, and then in the Australasian equities fund, Telix, again, a strong performer through the month, adding 9 basis points. And no surprise to see some of the tech mega cap names really dragging on performance for the month. So hopefully that was useful. And thanks again for your time. If anyone's interested in digging into the macro model in a bit more detail, more than happy to set up a call to discuss that. And if there are any questions on the back of this, by all means, please let us know. Thanks. Bye.